Hello and welcome to the Forbes India show. I'm Shireen Bhan and we're in conversation with Gunit Chadha. Gunit, appreciate you joining us here on CNBC TV 18. You know, we were having a conversation with the chief economist of the World Bank, Kaushik Basu, a few days ago, and he said New Delhi doesn't look as bad sitting in Washington than it does when you're actually here in India. And that was pretty much your view as well, because the last conversation that we had with you, and I want to quote back to you what you said about India. You said, we're constructive on India's GDP climbing back to 6.8% in FY 13-14. The Sensex at 22,500 by the end of the year. It's our view that the Reserve Bank will step in with a 50 to 75 basis point reduction in 2013. And combining all these factors, we think that 2014, notwithstanding the national elections, will be a much stronger year. It's a different world today, isn't it?
It is. Now, you know, it's not the first time or the last time I'd be wrong. But equally, maybe if you stretch India by 1 year forward, all those statistics will probably play out.
Even today, with the fact that the currency has actually lost 6% in the last 7 trading sessions, 11% this month, 20% year to date.
Our economists still believe that India will grow 5% this year and 6.5% in FY 14-15.
Your economists have also pegged the rupee at 70 by the end of this month.
And actually the same economists, including the chief economist of Deutsche Bank, David Folkes-Landau, says that the fundamental value of the rupee is at spot 64 rupees undervalued by 10%. So putting a fair value more closer to 60. So listen, markets can move into disequilibrium. Obviously, I'm not going to debate the 70 number. That's a number which was put out for September. But equally, the same economist had a 60 number in the summer of 2014.
So you believe that things will change and we're probably going to see some degree of stability return to the currency market, because it doesn't suggest that way.
So there is a lot of uncontrollables out there, and there are some controllables which certainly the government and the MOF and the RBI are doing. Certainly the capital flows train has left the emerging market station and is chugging away to the developed market station.
And the fear is that as QE does indeed start to taper down, and we haven't even seen that yet, but as it does start to taper down, India is not going to be home for capital flows, and we're hence going to be faced with perhaps an even more depreciating rupee, and then the case for Indian equities is not going to be as strong as it continues to be today.
And that could very well be the case, but as I said, there are uncontrollables out there. Now, whether that train which has left the station gathers pace is a function of when does the tapering start.
What's your assessment, September?
We still believe it will start in September. It's a function of what's the slope of that tapering. Is it more front-ended? Is it more back-ended? It's a function of how much will play out when the tapering actually starts versus how much is already played out in the expectation that tapering will happen.
How much do you believe has already been factored in or priced in?
I would argue that over 25% should have already been factored in, and the fear of the train gaining pace is also leading to currency volatility. So frankly, across emerging markets, it's a bloodbath. I'll give you a very interesting example. Take Malaysia. Malaysia as a country has a current account surplus of over 4%, right? And has strong fundamentals. And yet, its currency is depreciated by 10% in the same time period as the rupee in India is depreciated by 15. So frankly, even the stronger emerging markets without the twin deficits are facing the same headwinds on currency.
But the ones that are being punished more are the ones with higher current account deficit, countries like us, countries like Indonesia, and wherever you have that higher current account deficit, those are the ones that are being punished even much worse than countries like Malaysia, for instance.
Absolutely. But the point I'm really making is a bigger point, is that to start evaluating a country purely from the prism of currency is probably not a fair representation of the fundamentals of the currency, which is why, as I said, our chief economist believes that at spot the rupee is fundamentally undervalued by 10%. And now that does not mean that the technicals of the marketplace, the disequilibrium, could stretch into much higher levels. But that's not the fundamental view. So let's not extrapolate the currency view into the macroeconomic view, while I completely accept that the twin deficit countries are facing the headwinds absolutely much more than countries which are better place than that.
But what is the case for Indian equities? You know, 22,500 was what you said in March is where you actually would see the Sensex. We've seen the markets come off strongly. We haven't seen FIIs, though, by the way, pulling out of the Indian equity markets as much as one would have anticipated or feared that they would. And that's the Finance Ministry's argument that FIIs have stayed put in equities, whereas they've been selling in debt. Is there a case for Indian equities today, given the macroeconomic situation and the currency depreciation?
Oh, that's a very insightful comment. So foreigners or FIIs own roughly about $200 billion of the trillion-dollar Indian equities, right? So they are significant, but they're not as significant as, say, in Indonesia, where they own 45% of the market versus 20% of the market here, right? So absolutely, I think FIIs have stayed very much put. It reflects possibly their longer-term view of India, the fact that on a secular basis, India stays an attractive destination, whether it's the demographics, whether it's the consumption themes, whether it's the higher than normal ROEs which Indian corporates have generated over the last 10 years, whether it's the urbanization theme, whether it's the democracy, right? Notwithstanding the costs of some of that in today's world. So equity investors have stayed put, notwithstanding that India trades at a 30% premium to Morgan Stanley's emerging market index. So I completely agree with the finance minister and the Ministry of Finance that equity investors in India have stayed put in a relative sense. Sensex has lost 11 or 12% since May 22nd. Indonesian market has lost 25%, right? So it's important that the policies which the government takes to arrest the currency are not which are anti-growth.
So are you in the camp that believes that the measures that have been taken by the Reserve Bank have been counterproductive, especially when it comes to capital controls, which the government is going to great pains to say that it is not capital control?
So the government has taken a lot of positive measures. Let's first talk about them. The administrative measures they took in terms of, on the gold side, in terms of putting duties on some of the non-essential imports, the measures which they've taken to reduce the trade deficit, both June and July suggest that trade gaps are narrowing right now. In fact, I would even argue that what RBI did to keep the long-term bond yields in check was pro-growth, while they sterilized that by doing an operation twist and ensuring that the short-term interest rates take the speculation out of the rupee. So those were all pro-growth measures. Now, those quasi-capital controls, right, whether on the individuals or corporates for the overseas, I agree with you completely. Frankly, that was not needed, and hopefully, it gets addressed somewhere down the line. I still think growth is where the government should focus on, and the rest will follow.